Sure. So if I'm looking at multiple markets, the easiest way that I have found to track it is making sure there's always a connective thread between them. So for example, this morning I was trading Dow, crude, and Canadian dollar. So I know that Dow and crude typically have a fairly sympathetic correlation with the energies. I know that Canadian dollar is going to track with crude. So I think that's one example. And all the correlations, of course, they do ebb and flow. Correlations aren't fixed, and they're certainly not 100%. But overall, if I can find markets where I can take advantage of high concentration weighting within an ETF, or if I can take advantage of high concentration weighting within the index, it becomes much easier to understand that if I'm trading Microsoft and Apple, I can look at the XLK ETF and look at how that's tracking with the NASDAQ. So I'm always looking for connective threads. That's going to be at, say, the index and sector level. And then alternatively, the other thing would be looking at macroeconomic trends. So if I can find, for example, right now, I love the long positions in XLE and crude oil and RBOB gas. So if I can take advantage of a reflation trade, I know there's a technical trend in those markets, and I know there's a macroeconomic trend in those markets. That's another easy way to sort of look at one idea and see the knock-on effect work for me. So it's the lazy way of looking at multiple asset classes. But, I joke, it's not lazy. What it is the most effective way. But it also ends up being the easier way.